Welcome to the Strategic Investor Productions channel. In this video, we're going to take a look at the relationship between the reverse repo market and the supplemental leverage ratio. While many people think the reverse repo market is no big deal, others believe it must be signaling something strange is going on that we must be paying attention to. One thing is for certain. There seems to be a lot of disagreement on the topic. It seems to be analyzed with similar confusion to the 2019 repo bailout at the time that was happening. Hindsight is clear. The 2019 repo market craziness was a canary in the coal mine. Will we also look back on the reverse repo market craziness in the same way? Spoiler alert, I think we will, and here's why. First off, let's go over what a reverse repo market and a supplemental leverage ratio are. A reverse repo market, like the name suggests, is the opposite of a repo market. A repo market is where you can take your securities and sell them temporarily for cash with the agreement to rebuy in full with additional interest at a predetermined date. In a lot of cases, it can be as early as the next day. So the reverse repo market is where you can purchase securities with the agreement to sell them at a higher price at a predetermined date. The supplemental leverage ratio, known as SLR, is a ratio that measures a banking organization's on and off balance sheet leverage. It's a simple division problem where you plug Tier 1 capital into the numerator position and total leverage exposure into the denominator. Tier 1 capital consists of shareholders' equity and retained earnings. It is considered to be a primary indicator to measure a bank's financial health. Tier 1 capital is a bank's core capital and includes disclosed reserves and equity capital. Now that we understand reverse repos and the supplemental leverage ratio conceptually at a basic level, let's take a look at a brief history to understand a little bit more from a different perspective. So, starting in 2012, the U.S. regulators proposed the SLR. In 2013, the SLR finalized and the enhanced SLR was proposed. The ESLR in 2014 was finalized, and revisions to the SLR denominator were proposed. In 2014, the SLR denominator was finalized. In 2015, mandatory disclosures of the SLR were required. In 2018, both SLR and ESLR mandatory compliance began. In March of 2019, the St. Louis Fed published the first article regarding addressing the need for a standing repo facility. In September of 2019, the repo market needed to be bailed out. The Federal Reserve intervenes in the repo markets for the first time since the Great Recession. In March of 2020, the CARES Act, a $2.3 trillion stimulus package, was signed into law. Also in March of 2020, the Federal Reserve announced temporary FEMA repo facilities. In April of 2020, the Federal Reserve announced it would temporarily exempt treasuries and bank reserves from SLR calculations. In December of 2020, stimulus package number 4, which was $900 billion, was signed into law. In March of 2021, the American Rescue Plan, a $1.9 trillion stimulus package, was signed into law. And then also later in March of 2021, the SLR exemptions expired. And then at the very end of March 2021, the reverse repo market started going parabolic. In June of 2021, the Fed increased the reverse repo market rate from 0 to 5 basis points. In July of 2021, the Federal Reserve announced 2 new standing repo facilities, a domestic and a FEMA. I hope you can see how all of these events seem to be correlated in some fashion. Let's go through some of the major events in detail. On March 27th of 2020, the third and largest stimulus package was signed into law. It was called the CARES Act and has been the largest single relief package in all of history. Keep in mind this included direct cash payments to individuals that would be counted as deposits at depository institutions. In April of 2020, the Fed announced it would temporarily exclude treasuries and bank reserves from SLR calculations. This lowered banks' total leverage exposure and allowed them to take more risk. This was necessary because banks' leverage exposure had been increasing rapidly with increasing deposits, and the FOMC increasing the size of its balance sheet, causing a surge in bank reserves in the process. Keep in mind the exemption was allowed to expire on March 31st of 2021. This is a chart from the Federal Reserve website showing the total reserves of depository institutions. Notice how the deposits go up after the CARES Act was signed into law and direct stimmy checks payments were made to individuals. The SLR exemption allowed U.S. banks to expand their balance sheets by participating in Treasury auctions and the Fed QE program. Without SLR exemptions, they would have needed to increase their Tier 1 capital to do so. They would have needed more Tier 1 capital as the reserves we looked at in the previous chart ordinarily count against total leverage exposure, which is the denominator for the supplemental leverage ratio. You can see here that the actual date this exemption was announced was April 1st of 2020. This is a chart of reverse repos from the Federal Reserve website. You can see reverse repos were starting to get a lot of action after the CARES Act in late March of 2020, but as soon as the SLR exemptions was announced on the 1st of April, there was virtually no need for them until the exemption expired on March 31st of 2021. You can see it lines up perfectly to the date. On December 21st of 2020, the U.S. Congress passed Stimulus Package 4 that provided $900 billion in relief. This package included direct payments of $600 per person. And on March 11th, 2021, which was right before the exemption of the SLR expired, Joe Biden signed the American Rescue Plan into law, which provided $1.9 trillion in relief bills. This package also included $1,400 in direct payments to individuals. As you can see from this chart, reserves continued to move considerably higher after these two packages. So, the problem with reserves continued getting worse, but it didn't matter because they were exempt from the supplemental leverage ratio at the time. As the SLR exemption expiration date got closer, many people started to speculate on the significance of a potential expiration. I remember following this thinking they were going to extend it because of how important it had been over the previous year. I found a good article from the time that does a great job of explaining the thought behind the need to extend the SLR. I will include a link in the description, but my memory is pretty bad, so if there isn't a link in the article, make sure to remind me because it is absolutely worth a read. The article starts its theory off by reminding us that when the Fed conducts QE and buys an asset, whether that be a U.S. Treasury or mortgage-backed security from a bank, the bank receives a Federal Reserve deposit in exchange. A bank's total leverage exposure includes both Treasuries and Fed reserves. Therefore, as banks enlarge their balance sheets when participating in the Fed's QE, they will need an extension to the SLR exemption to continue participating in the Fed's QE program. Keep in mind how important that was to the overall success of the economy and markets over the previous year. Not being able to participate would be a big deal. Part B of their theory is where things get really interesting in my opinion. They start by saying that consumer deposits don't necessarily have to be held as Fed reserves. They can also be used to underwrite loans or held as U.S. Treasuries, which all three options have positive carry. Without the SLR exemptions being extended, the additional deposits coming from both Biden's $1.9 trillion fiscal package and the U.S. $1.2 trillion decline in the Treasury General Account will mean banks either need to charge negative interest on deposits to maintain their ROTCE or turn away deposits, which in that case will mean the only place left for them are depository institutions or money market funds. They then mention that uncapping direct inflows from $30 billion on the overnight reverse repo facility and hiking the reverse repo rate to just above 0% would go a long way towards alleviating the balance sheet pressure on commercial banks with or without the extension to the SLR exemption. While the SLR exemption did not get extended, sure enough, the reverse repo yield was increased to 5 basis points. This would counterbalance the Fed fund rate and provide a floor to SOFR rates. While the reverse repo inflow limits were not lifted, they were also raised multiple times. They started at $30 billion and now look to be at $160 billion per counterparty. The same article we were just talking about mentions the relationship with the TGA drawdown. They say that an uncapped reverse repo inflow limit would effectively provide a similar magnitude of relief as the SLR exemptions because a lot of the deposits can be absorbed by money market funds. This actually makes quite a bit of sense, and there is some correlation between the TGA balance and the reverse repo market on the charts. This is a chart of the Treasury General Account balance. Notice there is a point in the middle of the trend that looks like it bottomed temporarily before resuming back down. This is a chart of reverse repos. Notice that as the Treasury General Account was starting to go back up, that was the same point reverse repos had their first major pullback. I believe the reverse repo madness is a product of too many reserves in the system. This article mentions if the Fed plans to taper, then the accumulation of reserves on the bank's balance sheet will begin to end. Although if the recovery is volatile, there still may be a twist in the cards. This would entail the Fed lowering QE size but focusing their efforts more on the long end. They point out this would technically be a hike, as the short end of the curve would rise gradually. I agree with this article when it says it's clear that the SLR in non-exempt form doesn't suit the practical nature of how the Fed relies on banks' primary dealers to operate monetary policy. We could eventually get a revised SLR. In my opinion, the SLR since its start in January of 2018 has been a major factor in the performance of the economy. It incentivizes a strong US dollar as seen from this chart. The yellow date range shows from the date of mandatory compliance to the date of exemptions of reserves and treasuries from the SLR. This was about a 9% move higher in the dollar. You can see here how assets like Bitcoin have responded to the regime change. The red date ranges show the times SLR mandatory compliance have been in existence. You have losses of 66% and 27% respectively. The green box shows the period of time where U.S. Treasuries and Fed reserves were exempted from the SLR. This was a 928% move higher. Alright, to the conclusion. I'm not sure exactly how the adjustments to the reverse repo market are going to end up weighing out against the expiration of the SLR exemptions, but it seems like it's not going to be enough to counterbalance the event. It seems to me like an experiment that isn't going well. Since the SLR exemptions expired, we have seen assets sell off in aggregate and the dollar continues getting stronger. With more fiscal stimulus talks, this is likely going to continue making the reserve situation worse, which puts a lot of pressure on the Fed to begin tapering and raising rates without the help from the SLR exemptions. The Fed is not going to be backing the Treasury market with as much QE as it tapers, and banks can't take on any more leverage exposure. This is likely going to lead to a spike in yields that no one can afford and is going to lead to economic consequences. The next rock in a hard place the economy is going to find itself in is how it can get banks to add more leverage exposure in the form of Treasury purchases, and there isn't going to be enough of a solution with the SLR in place. They could completely lift inflow limits to the reverse repo market to allow money market funds to effectively be the overflow valve permanently going forward for reserves, but that's a wonky system. I think when rates become more of a problem, that's going to be a time where we might get some adjustments to the SLR, and I'll be watching that closely. The Fed is also talking about permanently establishing their FEMA repo facility and domestic standing repo facility that could have a lot to do with how they plan on handling the situation we're about to find ourselves in. So maybe the reverse repo madness is just a derivative of the real problem, but hey, that's what a canary in the coal mine is supposed to be, right? Alright, thanks for watching. This is a really complex topic and hasn't been getting a lot of attention in the media, so I hope it's a new perspective that brought you guys some value. We are a brand new channel, so we appreciate your patience as we learn how to YouTube correctly. Please like this video to help with the algorithm and subscribe with the bell icon to get notifications when we post new content like this. Have a wonderful day, all of you strategic investors.